what we're going to be going over here is an overview of the statement of cash flows and get a basic understanding of what that statement of cash flows is. Okay, so what I've got it laid out here is in a template form here. And when we're talking about the statement of cash flows, we're talking about different activities that the company has here. They're going to have an investing activity here, they're going to have a financing activity, and they're going to have operating activities. So what do we want to do for each of these activities here? We want to determine the change in cash. We have to determine either if the cash is being provided here to the company or if it's being used. Okay, so first for our investing activity, and again, this would be part of our assets here on our balance sheet, and this is really how we're investing in our assets here. And what we're talking about here is generally long-term assets like property, plant, and equipment, and how we're investing in that property, plant, and equipment, and what the change in cash would be here. Okay, so then moving over to our financing activities, that's broken down between our liabilities here and contributed capital or stockholders' equity here. So first for our liabilities here, again, we're generally talking about long-term liabilities here. That would be like bonds being issued here. And then we want to determine what the change in cash would be here, cash provided or used here. And then again, for our financing activities here, for our stockholders' equity here, contributed capital, we're generally talking about long-term in equity here, such as stocks here, issuing stocks or retiring stocks and so forth. And then finally moving over here to operating activities. Now this is really to do with our net income here on our income statement. And what we're talking about here is we're learning, have to determine the change in cash here between our revenues and our expenses here as part of our net income. And really we have two different methods that we're going to be looking at here to determine our change in cash here for operating activities. It's going to be the direct method here or the indirect method. So really we're going to be concentrating here on this operating activity here as part of our net income here on our income statement. Okay, so that's just our three basic activities here again. In investing activity, how the company invests in its assets here, financing activities either through liabilities or stockholders' equity, and then operating activities, the net income here or the change, our net income here on our income statement. Okay, so those are our three activities. Now let's just go over here and look at just a thumbnail sketch here of the statement of cash flow. So again, for those three activities, we list them in this order. We're going to have first our cash flows from our operating activities, cash flows from investing, cash flows from financing as a third here. And then we also have to have the cash at the beginning of the period versus the cash at the end of the period. So what we would do under each of these activities here, you have to determine what the cash provided or used would be for each of those activities. And then we start out with our net income here under our operating activities. And this is where we're going to be looking at how we would have to adjust that net income to determine the net cash, either provided or used. And that's what we're going to concentrate on next here. And then again, on each one of these activities, list the individual items for the cash that's either provided or used. Same here for cash flow activities, investment activities here again, cash provided or used, list the individual items. Same here for cash flows for financing activities. Cash provided or used, list the individual items that affect like financing, your financing activities here. Now, what we want to look at here is this change in cash here. So this is probably the easiest to determine here. Then your cash account, determine your cash at the beginning of the period. In this case, let's say it's $500,000. Cash at the end of the period, say it's $1 million here. So our change in cash is the difference here, $500,000, an increase of $500,000. And what you have to do here, knowing this change in cash here in your cash account, that has to match what your change in cash would be for each, the total amount here for your operating, investing, and financing activity. So if you look here, operating, we had $150,000, financing increase here of $225,000, and for our financing, $125,000, which if you add everything up, that totals $500,000 here. And that has to equal your change in cash from the beginning to changing cash from the beginning of the period to the end of the period. So that's a good cross check, and those things have to equal here. Okay, so that's the change in cash that we'll be looking at here. Now we're going to go up here and we're going to look at the cash flows for these operating activities and how we calculate that. Okay, now this is where we're going to be looking at this statement of cash flows again for our operating activities, and we're going to compare the indirect versus the direct method to determine the cash flows. So first starting with our indirect method here again for operating cash flows, and remember that's part of that's really starting with our net income in this case. So net income, looking at revenue minus expenses, that's what we have here, and we have to adjust our net income here. And what we're going to be doing here is we just take our non-cash revenues and we have to subtract that from net income here, and non-cash expenses we'd add it back to our net income, and those then taking the total here, whatever your adjustments making to your net income, that would equal for your non-cash revenues, non-cash expenses, that's going to equal what affected your cash or your cash flow here for the operating activities. So the reason we're adding these non-cash revenue or subtracting the non-cash revenues from our net income here is because initially we added them to a net income here. Now we would have to subtract them out here, the non-cash revenues here, because those would not have anything to do with cash. So by subtracting them out here, then we just determine what the cash amount would be. Now for non-cash expenses, we're going to add those back here, because again, adding those back, we initially subtracted them, adding them back here, so that'll bring us in line here to determine what our actual cash flow would be here. So just look at it in those terms. Now again, here's the required adjustments that affect the cash flow here. So looking at, again, we're taking these non-cash revenues, subtracting them back, and non-cash expenses, adding them back here to net income here. So this is what we're going to be doing here. So we take our operating assets and liabilities and we look at the changes here. So what we want to do is we want to compare the beginning amount in each one of these accounts to the ending balance in each of the accounts here to determine if there's any increase or decrease. And that's going to really be the indirect method here to determine what the change in cash would be. So just looking at our accounts receivable, say for example we had an increase. What that is really telling us here is that we collected less cash for the period here. So again, we collected less cash here, so that would be a reduction to our net income here. Now, remember what I talked about here where our non-cash revenues, we would be subtracting them out here. So, but what I'm showing up, and again, that's a subtraction here. We had an increase in our accounts receivable, so it's a non-cash revenue, but we'd be subtracting it out under the logic here that an increase in our accounts receivable, we collected less cash for the period. And then looking at our inventory, same logic here. Say we had a decrease in inventory, then we collected greater cash here for the period. So we would be adding that back to our net income here. Okay, and then remember, just the opposite would be true here. So if you had a decrease in your accounts receivable, that would be that you collected more cash here. And then again for inventory, if you had an increase in inventory, that would mean that you collected less cash here. So just look at what these are the adjustments that you'd have to make to your net income here. So for inventory, a decrease in inventory, you'd be adding that back here to your net income. Now looking at our accounts payable, say you had an increase in accounts payable, that means you paid less cash here for the period here. So that would increase your cash here, adjustment to your net income here. And then same opposite would be true. And then looking at your expense payables here, say you had a decrease in your expense payable, that means you paid more cash for the period here. So that would be a reduction here in your cash. So that would be a reduction here to your net income. So what you would do here, you look at your total cash flows for the period here, your adjustments to your net income, that's going to give your total cash flows here for the operations. So what you're really doing here, just looking at it here, if you're just looking at it in these terms here, if you have your assets here, if they're increasing, that means you have a reduction in your cash flow. If assets are decreasing, that means you have an increase in cash flow. So they're working in opposite directions here. Increases in your assets to your cash, or increase and decreases to your assets to your cash flow. Now, the opposite is true here for liability. So if you have an increase in liability here, that means you're going to have an increase in your cash flow, and a decrease in liability means you're having a decrease in your cash flow if you do the logic here. Now, just remember your liabilities here are working in the same direction here as your cash flow. Okay, so that's our indirect method here. A little complicated, but that's how you would handle it. Now, let's move down to the direct method here for our operating cash flow. So this is what you're going to have to do. You have to determine your cash receipts less your cash disbursements here. So first you start with you look at your cash collected from your customers here. Positive amount here. Cash paid suppliers would be a reduction, and cash paid for expenses would be a reduction. Again, totaling those amounts here, you're going to come up with your cash provided for operations here. Now, again, when you're using the direct method here, the net income and any non-cash revenues and expenses really are ignored in the calculations here. You're just looking at your cash receipts versus your cash disbursements. But what you want to do is determine if you have any what the cash is being provided or if it's being used here. So provided means you have an increase in your cash here, and used would mean you'd have a reduction in your cash. But using either the indirect method here or the direct method, your cash flow should be equal in either case. And I'm just showing it here. Cash flows from operations here, say for indirect method, say it was $500,000 here. So, and cash provided by operations here for the direct method, $500,000. Really, they have to be comparable using either method. Okay, so now let's go and let's look at this, our direct method here for determining our cash flows. Okay, so here we sit. And we're going to be looking at those three different categories that we talked about for our direct cash flows here. That would be a cash collected here from customers, cash payments to suppliers, and also cash paid for expenses here. So using the direct method here, let's look at our cash collected here from our customers. Let's look at our accounts receivable, and we want to determine what our cash collected for the period would be here. So again, accounts receivable, an asset here. So this is what you would have to be looking at here. You're going to have to look at your beginning amount here off your balance sheet for your accounts receivable. You have to know what your ending amount on your balance sheet for accounts receivable, and then you also want to know what your sales here under our accounts receivable would be here on your income statement. So just looking at our what we're going to determine our cash here, it really becomes a plug amount here. So again, these are the known amounts here. So we're beginning off our balance sheet. Just look at it. You get $300,000 here for accounts receivable beginning balance. Then we have for sales that go onto the income statement, we have $2,500,000 here, and then at the end of the period we had $340,000. Let's just say everything is in thousands here. So how do we get to our beginning balance and our sales to the end amount here of 340? Well, it just becomes a plug here. Your debits here, an increase in your accounts receivable, 300,000, and increase here in accounts receivable due to your sales, 2,500,000, and then you had to determine what your ending amount, you know what your ending balance would be. The plug becomes the cash collected here. So that would be what you collected here in cash, $2,460,000. So that's really how you get to determine what your cash amount is here, and that's using the direct method here. So we were able to calculate our cash here, knowing, again, look for whatever your beginning balance is on your, in this case, the balance sheet, whatever went over into your sales account here on your income statement, and then your ending amount here in the balance sheet, and to determine what, calculate what cash, in this case the cash collected, would be. Okay, so now let's go down here and look at our second category here, where we get cash payments to suppliers and specifically inventory here. Now this is really takes a two-step process here. So this is what you have to be concerned about when you're talking about inventory. So first off, you start with step one here, inventory, and you have to determine what the purchases would be. Again, remember, this is an asset here. Okay, so what you would start with, determine what your beginning amount here is in your balance sheet. Say it was 400 here, 400,000 here, and then we have to know what went to cost of goods sold here in the income statement. That would be a reduction to our inventory here. Let's just say it's 4 million. Let's stay with the 4,000 here. Let's just say it's 4,000 here. So credit, it reduces our inventory account. Now we know what our ending. We have to know what our ending is on our balance sheet here. So we got 360 or 360,000 here in the beginning. Ending amount here. So knowing those three amounts here, now we can determine what our purchases are here. So that's really a plug here. Debit of 400,000, a reduction or a credit here of 4 million, and then we end up with 360,000 here at the end. So the balancing amount has to be a debit or increase here as in our inventory as a purchase of 3,980,000. So that's simply a plug here between our beginning amount, what goes to the income statement, and our ending amount here on the balance sheet. Now, this is the key here. This does not go to the statement of cash flow. It's included in the accounts payable, any purchases here. That's why it takes this two-step process. So we take our purchases for the period here, this 3,980,000. Well, I got it showing here 960,000. It should have been, it's a mistype here. But nonetheless, you take your purchases here from what you had under your inventory account for the period here, and you move it into your accounts payable in this case. Okay, so again, this is where we have our step 2 here. We have to determine what our cash paid would be. Again, you start out with your beginning on your balance sheet, accounts payable here. Again, remember that's a liability account here. Say it was a credit here of 40 or 40,000. Then our purchases for the period here, that would be under accounts payable. In this case, we paid for them on account here, 3,960,000. And then the ending on our balance sheet, we had 150,000 here for the period. So how we have to determine our balancing amount here to get down to our ending balance here on our balance sheet here. And that would have to be a debit or a reduction in our accounts payable here of 1,925,000. So that would be the cash that would have to be paid here. So that's how we got to determine our cash payments to suppliers for inventory. Just remember, you have to go back and you have to determine what your purchases would be here using this direct method here, and then taking those purchases, they have to be moved into your accounts payable, assuming they were as accounts payable here. So that is what you do here to determine your your cash amount here under accounts that was paid here under your accounts payable. Reduction in this case to accounts payable. Okay, and then finally let's move down here and let's look at for cash paid for expenses here. And really, again, we got two different separate categories here. We got our looking at salaries payable as a liability here, what the cash would be paid, and then prepaid expenses here, what the cash would be paid. And this is an asset account. So there's two different, we have to handle these in a different manner here, the past cash paid for expenses here, because we got both an asset account here and a liability account. So starting with our liability account here for our salaries payable, for example, again, we start out with our beginning balance here in a balance sheet. We have to know what that is. Say it was 20,000 here. Then again, we have to know what we incurred here that goes to our income statement here. Say it was 500,000. And then we have our ending balance here off our balance sheet of 30,000. So how we would get our cash paid here is simply a plug here, a balancing amount between our beginning amount here off the balance sheet was incurred here, 500,000. So to get down to our ending amount here on the balance sheet of 30,000, well, we have to have a debit or a reduction here in salaries payable, which was 490,000 in this case. And again, that would be what the cash would be paid here. Now, moving over to the case here on our asset account here for prepaid expenses here, again, cash paid. Let's just say we have to know the debit amount here, or we had a beginning balance, balance here off our balance sheet of 400,000, and then our expenses here that went to the income statement here for the period was 900,000, and then our ending amount off our balance sheet again 100,000. So the cash here paid was 600,000 here. Again, just a plug between our debits and credits here. So again, we had to know in all these cases here, we had to know what our beginning amount was off our balance sheet, and what, if any amount whatever went to the income statement here for the period, and then we had to know what our ending amount would be. And then it became a plug here between our debits and credits. Okay, so that'll be really end our discussion here when we're talking about our statement of cash flow. So really, we had two different methods here to go through the statement of cash flow, and those, when we're talking about, and we concentrated on the operating activities here that we're talking about with those two different methods, and we had the indirect versus the direct method here to determine our cash flows. Just remember, when you're using the direct method here, just moving up here, just lay out your T accounts here, and then you can look to see, you have to know what your beginning amount would be and your ending amount, and then what went to the income statement for, in the case here, for your direct cash flows. And then knowing what was on your income statement, beginning and ending amounts, you can determine the plug. Now, when we're talking about that indirect method, that was a little bit different. We're really just looking at our beginning and ending balances. And we didn't go through all the arithmetic on it with the T accounts, but we just were comparing our beginning to our ending balances with the indirect method. We didn't have to really know what was going to the income statement in that case. Okay, so that'll end our discussion here on statement of cash flows, and we particularly concentrated on the operating activities. But just remember, there was also financing and investing activities as well.